Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of May 18th, 2025. And in this week's episode, I'm joined by fellow Blockhead trader Viper XL 007, and we are going to take a look at assignment. And assignment is basically when you sell options and the person you sold them to turns in that coupon and you are either short the shares or long the shares. In this case, we're going to talk about being long the shares because you were forced to buy something. And I'm going to go ahead and use LULU, an earnings trade that I put on and ended up getting assigned, and talk you through what happened post-assignment and why you really shouldn't be afraid of assignment, as your profit likely, in many cases, will exceed the original profit that you targeted with the initial trade. So, before we hop to that, I want to give a shout out to our Discord, link in the description below. Hop in there. You can say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, as well as /ViperXL007, where Viper and I post each and every one of our equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know, and we will get it there. But let's hop to this week's episode. Viper, welcome to Earnings Continued. And this week, I thought we might take a small break from some of the trading strategies that we've been putting on in the past couple of episodes. And I wanted to talk a little bit about assignment because assignment is something that is very real possibility, actually in both of our strategies. Your particular strategy has a protection leg, so you don't really end up with a position that you can't hold. My particular strategy would end up with a position, and I don't really have a protection leg for that. And I'm really kind of okay with that assignment. And I really want to talk about some of the mechanics about, what does that mean when you get assigned, and show you an example of a LULU earnings trade that I did back in March. And was early assigned eventually on that trade. And the tides have started to turn and things are looking real rosy right now for me. But before we hop to that, I'm just curious, Viper, have you ever been assigned an options contract yet?
No, I don't think so. I think I've largely avoided it, even if I have the protection leg. It's one of those things that there's no reason to be wary, but it's also one of those things that there's just that stigma to it of like, I don't know, are they going to get it right? Is it going to, I don't know. So, I have not had a position get to that point yet.
Yeah, it's an experience. I will tell you that for me personally, I was, I watched a lot of videos about it. I knew all the mechanics. I kind of understood what was going to happen, but I don't know what it was. I was just scared of assignment. Every options trade that I took where I didn't have a protection leg and basically selling a put, which was largely all I did was sell puts back then because selling calls just were too scary for me. But when you sell a put, you do have that risk that the other party is going to put those shares to you at your strike price. And I don't know what it was. I just felt, what's this going to do? What's going to happen? And since then, I don't know how many times I've ended up being assigned. I probably have, I don't know. I can go to my thetagang.com /sprocket888 site and probably check. But I feel that I've probably been assigned a small percentage of them, maybe less than a dozen times I've been assigned out of a few hundred trades. But now I feel like I'm a pretty well-seasoned assignment veteran, and I just want to kind of talk a little bit about what happens when you get assigned. So first thing that I want to bring up is never take assignment on expiration, in my opinion. Basically what that means is you have an option strike, and as you approach expiration, at the time of expiration, if that option contract is even 1 penny in the money, the options clearinghouses will assign you that contract, and you will be put those shares at whatever that strike price is. And one thing that I never knew, but I will tell you now, is you cannot get assigned an option in the middle of the day, in the middle of the trading day. I kind of thought that could happen. I guess I didn't really read much about it. And so I was, as I was in the money on an option trade and expiration was coming up, I kept checking my phone going, am I assigned yet? Am I assigned yet? How will I know when I'm assigned? I'm not assigned yet. Turns out assignments never happen during market hours. So the way that it works is once the market closes, I think everybody has about 15 minutes to turn in to your broker, please exercise my contract. But at the end of that 15 minutes, all those people that say, I want to exercise my contract, that all goes into the options clearinghouse. The options clearinghouse takes a look at all the people that sold the options and randomly will assign somebody to fulfill that contract. So it doesn't have to, once you sell an option, it's not necessarily the other party that decides to exercise it because you're basically put into a big pool. But then that assignment takes place after hours. And in my case, my brokerage never really notifies me until about midnight or 1 a.m. I think that must be when they process all the stuff. And then I usually wake up and there's an email that says, oh, you've been assigned an option, immediate attention. And I'm like, I don't know what I'm going to do differently with this immediate attention other than, I guess I have shares now. So that is one real important aspect. And basically what happens is you purchase those shares at whatever price you said you were going to buy them at. So if it's a $90 stock and you bought 100 shares, that's $9,000 that you pay for that. Now, if you happen to have a margin account, that won't actually consume 9,000 of buying power. I believe it's 50% of whatever the value is what gets consumed as buying power. So your brokerage will say, oh, you got to give me $4,500 in collateral while you hold these positions. You might think, well, what are you going to do with those shares? Well, a couple things that I do when I sell, a couple of the prerequisites is, one, I have to be okay with assignment. It means I have to want to own the shares, or I have to be okay owning the shares. So this limits the amount of underlyings that I will trade. Now, while I don't need to know everything about the company or really much of anything other than some of the numbers, I will stray away from things I have not heard about. So if it's some small company, not a lot of market capitalization, and I've never heard of it, I basically just won't sell it. So I typically try to only play options trades or sell options for assignment of the big hefty names, your Microsoft, your Tesla, all these Palo Alto, things you've heard of. Now, sometimes I won't have heard of it, but I will at least kind of look it up and be like, oh, wow, this is a major player in battery material for lithium ion batteries. Okay, they have, 5 million shares a day that they trade every day. That's something I will go ahead and get in on. And so some of these stocks will pay dividends. And so if it pays a dividend, even greater, because if I end up getting assigned, I get to collect that dividend. And then what do I do while I hold it? Well, one, depending on how far down past the strike I go, I will turn around and try to sell a call against it. And a call basically just means that somebody can call those shares away from me at a particular price. Now, I will always pick a price that is greater than what I paid for them. Because it's really silly to have people call shares away from you for less than what you paid for them, because that's basically locking in a loss when it comes to things. Now we kind of talked a little bit through about assignment and kind of what happens. And, after hours, if you get assigned, you wake up the next morning and you'll have the shares in your brokerage account, and your buying power will be reduced by whatever margin your broker is requiring you to put up to hold those shares. And the reason I basically say don't ever go to expiration with your option is make somebody raise their hand early and say, I want you to be assigned now. Because most of the time people will not force early assignment because they're playing the price action. They're using the option as a proxy to trade the stock. They don't actually want the shares or to exercise the option. And so the week of expiration, I'll try to push up to, 2 days before, 3 days before expiration, and I'll go ahead and roll that if it's in the money. And most of the time, they will roll the stock, and then I'll collect premium, and then I'll just wait for more time for the price to recover. If it goes deeper in the money, I'll just roll again. Now, at some point, you will reach a price that is so deep in the money and things look so bad that somebody will raise their hand for early assignment. But why not collect that extra little premium, those extra pennies on a roll? Because what's the worst? If you're going to hold it anyway, you might as well collect a little bit of premium and force somebody to early assign. So let's take a look at this LULU profit and loss table first, and then I'll show you kind of the Flappy Bird chart and some of the price action that was associated with what I'm going to bring up here as far as the chart goes. So this, like I said, was back in March, the very end of March. So on March 25th, I sold a 305 put and a 375 call, which was hey diddle diddle, right down the middle before earnings. Looking for a wonderful contraction. I mean, this was like 3 days to expiration, and I collected $7.45 a strike. So netted, $14.90 on that. It crashed through the bottom part of that strike, and I was in the money, and I waited until the day of expiration, which was the 28th, and I went ahead and I rolled the put as it challenged and broke through the bottom side. So I let the call expire worthless, and I rolled the put forward, both of the contracts, to the next month. And I was able to collect $5.20 on a net credit. I think I had to pay like $14 to buy the thing back, but then I was able to sell it for like $19 and change for the next month. Fast forward to April 3rd. So this was going to go to mid-April, I think like April 17th or something like that was the expiration of it. It was the next monthly expiration. But then on April 3rd, which was actually Liberation Day, or the day after Liberation Day, I can't remember what time that announcement was. Anyway, the stock just absolutely tanked even more because Lululemon was a big importer from other countries, and tariffs hit it really hard, and people just said, wow, you're going to buy this for $305? Fine, you buy it for $305. And it was trading at the time probably in the mid 200s when I got assigned. So you might be thinking, wow, I bet that didn't feel very good. But like I said, I was okay with assignment because I thought there was a potential price appreciation or something like that with LULU. So, getting assigned early. Now, did I think it was going to get whacked down as much as it did? No, of course I didn't. So yeah, tariff Liberation Day hit. And I got assigned. I basically had to pay $305 for each of the shares. I bought 200 shares, and that took up about $8,500 in buying power, which is roughly 50% of the asset value at the time, approximately. And then I waited and kind of seeing where Lululemon went, and slowly we started to gain. Started to gain, and then this past weekend. Some China deal trade stuff started to emerge, and Lululemon had already gained back a ton, and it started taking off like a rocket ship. And so then Monday, I was able to look because I was I was around my strike price of what I originally bought it for. So then I went ahead and looked out to about a 30 delta and sold 2 covered calls at around $320 strike, which basically means I could get those shares called away from me at $320. And I sold 2 of those for $11.50 each, expiring at the month of June, the June monthly. So, about 30 days to expiration. So I collected another $2,300. Now, let's assume that I get assigned early, because if I don't get assigned early, I'm going to keep rolling this thing no matter where LULU is trading, if it's even deeper in the money. But let's assume that I get assigned at that 320. That is basically $15 above the strike that I sold at. And remember, I did 2 of those, so that's $1,500 for each contract that I would net in profit. There was 2 of them, so that brings up to a $3,000 profit. So you add all of those things together, the original trade, which was $14.90 in premium, the $10.40 from the roll, the $2,300 from the covered call, and the $3,000 assuming I get assigned, and you end up with $7,830 collected in profit on this trade out of an $8,500 buying power hit Now, the buying power was a little bit less on the original trade when it was just options, but once you're assigned, that buying power kind of increases to, whatever that you had to pay out for it. That's a 92% return on capital in about 2 months, depending on when and if I get assigned. But that, in my opinion, is not too shabby from an original trade that was targeted to bring in just about $1,500 in premium. So just to show you what some of this price action kind of looks like with my strikes, let's hop over to the Flappy Bird chart. And the Flappy Bird chart is really where I kind of like to show, where these strikes line up. And if we go ahead and look at this here, I've got this pulled up. This first skinny red box, this is the original call of the week of earnings and the corresponding put down below. And you can see we were trading right down the middle of that. And this massive red candle right here is where the stock price really dropped down. Post earnings, it was right there at my strike, but it didn't hold. It basically crashed through and continued to decline down here to about 280. And this big drop off here was after hours on Liberation Day when all the tariffs were announced, and we just dropped down again to about 250. So you can just see this massive drop down, and this bigger red box here is my roll. So I did that roll basically on the day of expiration of the week of earnings, pushed it out, collected more premium, and I actually ended up getting early assigned here on April 3rd. So the rest of these, bouncing around, it really didn't go out to this expiration. I got assigned early. And then you can see we kind of started bottoming out here, and we started to slowly kind of gain and gain and gain. And then this massive green candle right here is when the trade deal was announced. And then that following Monday, which is right here, we were trading at about 305 when I put the trade on. And I considered selling a call at the money because at the money I could have gotten even more premium. But what I decided was with this momentum that I would try to go ahead and push the strike further out because the net benefit to me was a little bit greater at the 320 strike plus premium than if I did an at the money thing. And so this big red box here is where my call is at the 320 strike. And basically if we start going up into this box, this is where I could be early assigned, and I would basically net the 3,000 extra things there. Now, if we get close to the end of this box and we are still above, I will roll and I will collect more premium and I will force early assignment. But if not, I will take early assignment if somebody happens to put that upon me. So Viper, I know your strategy, you technically do run the risk of an early assignment. Now, if you did, you have your get out of jail free card, which is your long option, so you can just pass on the assignment to somebody else should you want to, but you are not obligated to do that. And the broker will not auto exercise that for you. So in your case, if one of your earnings plays are in the money at expiration and you choose not to roll it, you could get assigned, or you could get assigned early. I don't know if any of this kind of strikes you as interesting, or if you had kind of considered some of the power of what you might do upon assignment, or any thoughts you have on kind of the mechanics here.
Yeah. So, I mean, like you said, the get out of jail free card has been the main focus. And more so it's the focus of being able to take much larger tickers, doing I forget the exact ticker now, but something that's like $150, $200 or something like that, where my account, the account that I'm using for this doesn't have that buying power. So I've mostly used that protection for that mindset of like not being able to participate in those larger equities without worrying about that size impact. But it did. I think it wasn't the ACHR, but it was one of the recent ones that it was in the money. And I was looking at the scenario you just talked about where the short month was going to expire in the money. And it was a small enough ticker, and I had the cash available for early assignment. And I actually took it to expiration day, didn't get early assignment. And I thought about it, yeah, because we talked about it on like 2 or 3 episodes ago, and how it would convert, essentially to a long position for the shares. But in the end, so that was the most conscious moment I've had around the idea of whether or not to stick it out and see what happens when we go into assignment. But in the end, I ended up not doing it, and I closed that spread out on that day. It was still in profit, and some of the reasoning behind that was stuff we can get into in a future episode about the calendar spread mechanics. But the main reason was that was a divergence from the thesis of which I took the earnings trade, which, again, not to get too deep into the weeds, but the thesis, whether it's right or wrong, that's still, being proven out. The data is still coming in. But the general thesis I'm taking on all of these earnings trades is to use the calendar spread to capture the volatility crush without necessarily extending the calendar spread into assignment and juggling and that sort of thing. So on that front, haven't actually used or gotten into the assignment position. But the rolling thing, I have started doing that with some covered calls, and that is far more interesting than I expected it to be, and far more profitable than I expected it to be. So that's kind of opening up in some of my bigger accounts, retirement accounts specifically. That's opening up a lot of potential there to start playing around with rolling options more, covered calls specifically, especially because you're a little more limited in some of the retirement accounts. So certainly interesting and looking into it on that front.
Yeah, I'll just kind of echo that the surprise that I too had the same thing. So I have certain tickers that I actually have shares on, through assignment, through other means that I purchased, stuff like that. And I was extremely surprised to sell covered calls against and realize how very infrequently you're ever early assigned, and how much those little rolls of selling a covered call really add up in the grand scheme of things. In my particular case, I think I was able to sell the covered call somewhere around $200 per 100 shares, and that 100 shares was probably in the realm of $8,000 or $7,000 of value. But the broker then only has you put up 50% of that as far as collateral, as the margin requirements. And so, I'm getting a return of effectively $200 a month on, $4,000. And that just adds up month after month. And I was very surprised to see that in the following month, I would be in the money, and I was still able to roll that thing forward another month and collect another $200 in many cases. Sometimes more, sometimes less. That was my average. It's a synthetic dividend, in my opinion. So the particular underlying that I had didn't really pay a dividend. But this act of selling the covered call was effectively making a dividend of about $2, or I should say a little less than that, because it was $2 for 100 shares. But it effectively gives you a synthetic dividend. It was great.
Yeah, that buffer of not getting early assigned is definitely something that I understand a lot more now, but it's still going to take some time to wrap my head around the potential around that. Just because, like you said, like in my head, so this covered call that I did in one of my retirement accounts, it's the first time that I've really deployed a covered call as a means for premium capture. I mean, the underlying was down. And honestly, the call that I sold is not at my purchase price. It's actually for a little bit of a loss. And so naturally, when I finally decide to do this, the price goes flying through it. So that checks out. So in my head, I was like, I mean, first and foremost, I figured out the loss if I did get assigned. So certainly want to call out and emphasize the risk tolerance, and I was okay. The underlying had pumped a little bit when I sold the call initially, and I was like, all right, this is cool. Thought maybe it would retrace a little bit, but then, just the nature of the market right now, and it just started going. And so in my head, I was like, okay, this has like, $105 strike or whatever. And so, shoot, like we're going to fly past that before expiration. So in my head, and, we refer to these, we refer to naked puts, covered calls as paid limit orders. On my head, I was really in the limit order mindset. Well, we're going to hit that and it's going to trigger. And that's just not the case. So I still had like 2 weeks to expiration when I rolled. So I think I will find that was probably, and it sounds like from your experience, that was probably a little premature. And I probably could have gotten a better roll had I waited, especially considering how far this thing has run. But at the end of the day, kind of also we talk about doing the thing, touching the mechanics. I'm now gaining a much better sense of what's going on under the hood. And it definitely opens up a pretty cool option for exactly kind of the scenario you laid out.
Yeah, for sure, Viper. They're excellent points. I agree with them 100%. It's just the magic of what I guess I didn't even really hear, but what I experienced when I went and did the thing. I definitely share the same sentiment as you. But that brings us to the end of this week's episode. Just talking through the covered call and assignment, because when you play earnings, it's wonderful. Your probability of profit is very high. It's very instant gratification. There's lots of pros to it. But one of the cons, and I don't think it needs to be a con, but the perception of it is that assignment is bad or can be bad. And you do really run a legitimate risk of assignment around earnings simply because of how much an earnings trade can move. And yeah, that's mitigated a little bit by the elevated volatility and the premium that you took in and all of that stuff. And hopefully you could see from a recent example of my own that it's really not the end of the world, and there is light of the end of the assignment tunnel. And if you're like me, it has a lot of scary connotations to it. But once you kind of go through it and really experience it, you're like, oh, that wasn't so bad. Oh, wow, I actually came out ahead of where I thought I was going to come out should the trade have worked the way that I wanted it to work. Your capital is tied up a little bit longer. My earnings trades are typically done in, 2-3 days. And this one has now gone on for about a month and a half, and likely still could go longer as I'm not actually assigned yet. But this is the type of thing that you just start to learn, and you bake it into your strategy, you bake it into your portfolio, and this covered call can become a synthetic dividend, even when it's not a busted trade that you took assignment on. So hopefully some of the stuff interests you and hits you in a way that you consider this and maybe add some of this or try some of this in your own portfolio. Hopefully you're finding things out there to trade for your portfolio. Good luck, have fun, and remember, think outside the block.